When global conflicts hit the wire, markets fracture. Algorithms react instantly, volatility spikes, and millions of investors find their screens painted red. Your brain evolved over thousands of years to prioritize threat detection and flight. It is a primal survival reflex designed to keep you alive in a physical crisis. But that reflex is toxic in a modern portfolio. Liquidating to cash provides immediate emotional comfort while locking in a permanent loss to inflation. Chasing defense or oil stocks at the peak of a headline cycle feels proactive, but it often results in buying the absolute top. The 24/7 news cycle feeds on this anxiety. You refresh your feeds at midnight, watching footage of conflict and letting the fear of missing out dictate where your savings go. Every time you hit sell in a panic, an institutional buyer is likely on the other side. They rely on retail fear to quietly scoop up valuable assets at a significant discount. This diagram illustrates the divergence in how investors handle a shock, the reactive path versus the rules-based institutional framework. The reactive path relies on guessing. By trading based on the latest breaking banner, you chase momentum and end up holding crowded, expensive assets just as the smart money begins to rotate out. Large institutions take the bottom path. They accept the initial volatility and run a structured three-phase framework to reposition their capital while the news cycle is still focused on the initial shock. We are going to map out that three-phase system so you can move past the headlines and look at the underlying mechanics of where the money is actually moving. Because in a crisis, capital does not simply vanish. It travels. It flows systematically away from the panicked and toward the prepared. Phase 1 is the shock. Automated systems dump risk-heavy assets like high-growth tech, triggering a cascade that drives retail investors to liquidate their portfolios. Fleeing to cash offers a sense of safety, but you are trading temporary volatility for a hidden structural loss. This flowchart tracks the path toward financial repression. A supply shock pushes oil prices higher, which keeps inflation elevated and forces central banks to maintain higher interest rates for a longer duration. Economists have seen this pattern before. After World War II, U.S. debt was over 100% of the economy, but it dropped to 23% in a single generation. This wasn't because the debt was paid back. It was because low rates and high inflation allowed the debt to shrink against a growing economy. This same process eats into your savings. Every month you sit in cash waiting for the news to improve, your purchasing power is quietly being eroded to service global debt. Chasing the initial commodity spike is equally dangerous. Historical data shows that oil price jumps driven by war typically fade within 6 months, often leaving retail buyers trapped at the peak. Phase 1 is designed to force an emotional choice. You either accept the slow bleed of cash or risk a fast loss by chasing a headline that has already been priced in. Phase 2 is the repricing. The raw panic settles, and the market begins to evaluate long-term supply chains and the actual persistence of inflation. This is the moment for portfolio tilts. Instead of guessing a direction, you make small, probabilistic shifts to lean your capital toward assets that benefit from these structural changes. Tilt 1 is energy infrastructure. Rather than gambling on the volatile price of a barrel of crude, you buy the storage tanks and pipes. You trade the chance of an explosive short-term gain for the reliability of a toll collector. These companies get paid for moving the energy, regardless of what the daily spot price is. Tilt 2 is broad defense. Major global alliances are shifting defense spending targets toward 5% of their economies, creating a wave of guaranteed government contracts. A significant portion of this capital is flowing into unmanned, AI-driven systems and autonomous defense technology. By focusing on Phase 2 tilts, you align your money with permanent infrastructure and policy spending, allowing you to ignore the daily fluctuations of conflict. Phase 3 is the rotation. Capital actively migrates away from the winners of the previous cycle and pools into sectors positioned for a high inflation environment. Tilt 3 is precious metals. Central banks are currently hoarding physical gold at the fastest pace in decades, largely to diversify their reserves and protect against the risk of their dollar-denominated assets being frozen during geopolitical disputes. For the individual investor, the trade-off is time. Institutions manage these prices heavily in the short term, so gold and silver require a multi-year horizon and the discipline to accumulate only during market dips. The final tilts involved hunting for quality moats while ruthlessly cutting rate losers. A quality moat is a business that can raise its prices to offset rising costs without losing its customers. Conversely, highly leveraged sectors like traditional real estate and utilities often struggle under the weight of sustained high interest rates. Phase 3 rotation requires a clinical evaluation of balance sheets to separate companies with pricing power from those being crushed by their debt obligations. This scorecard maps execution strategy to your discipline. If you are a reactive investor, your best move is a total news blackout and index funds to avoid panic. The intermediate optimizer deploys the 5 tilts using strict position caps. Success with this strategy requires accepting that structural adjustments take months to play out. You have to ignore the noise and wait for the institutional rotation to complete. Navigating a period of market repricing is fundamentally about detaching your actions from the morning news. You can spend your time reacting to every headline, losing your sleep and your savings to a screen. Or, alternatively, you can adopt a rules-based system that allows you to remain calm while the chaos passes. True financial security comes from exchanging the emotional trap of reactive trading for the calculated resilience of institutional patience.